Welcome to No Nonsense Nonprofits. Hi, I'm Sandy Ray, founder of Sandra E. Ray CPA, where we alleviate financial headaches so that you can create a bigger impact. Today, we're going to be talking about understanding conditional contributions in our not-for-profit accounting. Many nonprofits assume that grants or cash received can be immediately recorded as revenue, and that isn't always correct. Under generally accepted accounting principles, specifically ACS 958-605, that's revenue recognition for nonprofits, some funds are considered conditional contributions. And conditional contributions can only be recognized as revenue when the condition is met. So that ensures the transparency in our reporting and that we're in compliant with U.S. generally accepted accounting principles. So what we're going to cover today is we're going to talk about what are conditional contributions, how can we identify them, and when are we allowed to recognize the contribution or the grant as revenue. So let's get started with what is a conditional contribution. Now, these are any type of contribution or grant where there is a condition that has to be met before we've technically earned the contribution. And if the condition is not met, then potentially we have to refund the money. So what we're going to do is we're going to record that. If we receive the cash up front, we're going to record that as a liability. And then as the condition is met, we're going to do a reclass entry to reduce the liability and recognize the revenue. Now, a contribution that's conditional, a condition is just a barrier. Is there something that we have to do, a barrier that we have to overcome in order to actually earn that, not earn, but recognize that revenue? And again, if the funder has the right to receive that money back, get a refund, or maybe not make the contribution in the first place or all of the contribution, then that is a condition and it has to be recognized as differently than an unconditional contribution. So what counts as a barrier? A barrier is a requirement that we have to fulfill. It could be a performance obligation, for example, a set number of people or delivery services that we have to perform before we've met those conditions. A perfect example is a matching grant. We have to raise a certain number of dollars in order to receive the matching contribution. Cost reimbursement grants. We have to actually incur those approved expenditures in order to recognize revenue. That's why we delay the recognition of the revenue with cost reimbursement grants. But not all requirements are barriers. Things like administrative tasks, periodic grant reports, these are typically just compliance issues and not conditions. So the area can get a little gray, but you really want to take your time to read the grant carefully and understand it. What's an administrative versus compliance type of requirement versus a condition, and our ability to recognize the revenue. So I kind of alluded to this a little bit before, but I want to talk about when we can recognize the revenue. And timing matters because many times these grants or contributions will cross our fiscal year and we'll need to report that accurately, not only to our board on a regular basis, but on our 90 and our public disclosure documents. So the first stage is when the grant is awarded. We're not going to record any revenue if there is a condition or a barrier that we have to meet. Now, if the cash is received up front, we're going to record a liability on our books called a refundable advance. And then as the conditions are met, say we raise that matching money or we do get those number of constituents served, we can recognize the revenue. And I would recommend that you do this periodically, maybe monthly, that you look at those conditions and how much of that revenue can be recognized. We're going to reduce that liability and we're going to record the revenue on the books in that period. So the flow is this. If the cash is received, we're going to record a liability. And when the condition is satisfied, we're going to record the revenue. Now, this ensures that we recognize income only once it's truly earned. Now, many people get confused between what's a condition and what's a restriction. After we've met our conditions, then we're going to look at, is this revenue restricted or not? Restrictions apply to how the funds must be used for a specific purpose or a specific period. So once the contribution is recognized as revenue, we're going to look at restrictions. And that's when we record the revenue, if there's restrictions associated with it, it's going to be restricted revenue. And we're going to have to look at our net asset classification as well. Do we have net assets with donor restrictions or without donor restrictions? So the timing of the condition is going to dictate when the revenue is recognized, and then the revenue is classified as either restricted or unrestricted. Now, a contribution can be both. It can be conditional and it can have restrictions. So again, we want to look at, are the conditions met? A perfect example is a matching grant. Say we have a matching grant for a specific program. We need to raise $10,000 to receive a $10,000 contribution that's restricted for, let's say, back to school backpacks and school supplies. So the money is received, we're going to record that liability. And then as we raise the matching money through our fundraising efforts, we're going to reduce that liability and record restricted revenue until we get to that $10,000. And our net assets are also going to increase. Our net assets with donor restrictions or restricted net assets are going to increase by that $10,000. And then we can go out and we can purchase those backpacks and the supplies that go in them. And we can record the release of restriction for the $10,000 that was received. So to summarize everything, a conditional contribution is funding that cannot be recognized as revenue until the conditions are met. It's a measurable barrier, and the donor has a right to reclaim the funds if the condition is not met. And until the condition is satisfied, we cannot recognize the revenue. We're going to record that as a liability called a refundable advance. And only after the conditions are met, we are going to reduce that liability and recognize our revenue. So understanding this concept helps nonprofits stay compliant with generally accepted accounting principles. It makes it very clear to the users of our financial statements what we have, what is potentially refundable, what we've earned, what we've released from restriction. Our financial statements for that grant is really reflective of what's actually occurring. So I would like to encourage you to look at your grants and your financial statements. And if you have any questions, please let us know. We are always happy to answer those, whether it's this topic or something else. And I hope this was helpful for you. And I want to thank you for joining me today. We always appreciate your likes. And remember that creating a bigger impact starts with stopping the nonsense. If you're dealing with nonsense in your nonprofit organization, we'd love to help you cut through the noise.